told. And to read the tea leaves, we have a market master joining us. Nilesh Shah, Managing Director, Kotak Mahindra Asset Management Company, joins us. Morning, Nilesh. Thank you very much for staying up for us and not going on the year-end vacation as so many of your peers have done. Well, at this juncture, what does it look like? In the first place, your investors keep the faith? The year 2015 has been remarkable for the return of the Indian investor. Does 2016 be a follow-through year for this trend?
I hope and pray that yes. As Indians, we have invested a lot more in physical assets like gold and real estate, which are slow-moving trains. And we have sold our equities consistently over last 20 years, which is fast-moving train. Year 2015 was a very good break from that tradition, where Indian investors invested more than 65,000 crore in equity mutual funds. In last 20 months, we have collected more money than what we have collected in previous 10 years. So the overwhelming support of domestic investors is very, very encouraging and heartwarming. More importantly, a lot of this money came by way of SIP. About 25,000 crore is the annual subscription through SIP in equity mutual funds, which is again the perfect way to invest in equity. Obviously, we owe a great amount of responsibility to this inflow. Their expected returns have not materialized, and we need to engage with them to ensure that they remain invested over next 2-3 years, by which their expected return will materialize. So very heartfelt thanks to all the domestic investors. And now we owe to them to engage with them to ensure that they continued investor in this phase where the returns have been little bit below their expectation. Hopefully we will make it up over next 12 to 18 months.
All right, well, just hold on to that. There's some important information coming in on Cadila Health, where they've received a warning letter from the US FDA, and that stock is tanking now. This is relating to its Moraiya formulation facility and its Ahmedabad API facility. So they've, I think, received a warning letter for 2 of their facilities, Moraiya formulation and the Ahmedabad API facility. They've also said that they take quality and compliance matters very seriously and stand by their commitment to fully comply with the quality standards across all the facilities. The company is working hard to ensure that the commitments made to the US FDA are fully completed. So they do mention that there are no products in the US markets which uses the API of the Xifen facility. That's the latest casualty. Cadila Health is now down 10% at this point in time. They also say that they will respond to the US FDA immediately within the statutory time permitted, and they are committed to resolve all the issues. Well, that's the big landmine that you're seeing there. Cadila Health, a US warning letter for 2 of its facility, Moraiya Formulations and Ahmedabad API. Nilesh, come in on this. You know, this has been the big story this year in the pharmaceutical space, where so many of these companies have just been plagued by US FDA issues. Cadila Health is the latest in that bracket. How do you approach this space now?
So one, from an investor point of view, will have to start differentiating between companies whose quality track record is superior compared to others. Second, we'll also have to start providing for an opportunity in our portfolio to buy this pharmaceutical stocks when they are on the way down, courtesy this kind of event. So if we see our portfolios over last 1 year, we have been reasonably underweight pharmaceutical sector, and we have started accumulating this pharma stocks, especially when they have started correcting from their high valuation, courtesy and event risk like this. So do provide for margin of safety in your pharma allocation, especially to take care of event risk like this, which is becoming quite regular across most of the stocks.
Point taken, Nilesh. Let's just get in an analyst who is tracking the stock very closely to check out what's
this, because the stock is now down almost about 14% odd. Nilesh, for a company like Cadila, where, as Ekta was also telling us, 483 observations were made on a plant on this Moraiya facility in the past. So perhaps there was some inkling of, these issues. So far, it's not translated into an import alert. But what do you do when there is some inkling of US FDA issues? Do you ditch these stocks completely, or do you still keep the faith that these issues can be settled in the due course of time?
I think most of the companies in India are cognizant of the fact that there are strict quality standards prescribed by US FDA, and no management, no sane management would like to take risk with those processes. It is also evident from the fact that while there are various warnings issued onto the factory, it has not resulted into product recall. It has resulted into future product not being introduced from that facility. It proves that the product quality is good, but probably the environment which ensures the tasting of product quality or which results into manufacturing of this product requires some modification. So we engage with the management to see what is their opinion about managing such alerts, managing such warnings. And as I mentioned earlier, it's time to keep some amount of margin of safety for averaging yourself down in case an opportunity comes in some of these stocks.
Okay. Well, Nilesh, I actually had a slightly longer term question on equities and equity investors. When we started off 2015, the expectation was that debt will also give you a lot of returns. We had not had any rate cuts at all, and the expectation was some 200 basis points will flow, and 125 basis actually flowed. 40 billion coming in from FII debt investors. There is no such hope for 2016. So do you see a beeline from debt investors into equity investors in the domestic space?
Lata, your question is very valid. However, most of the investors who are kind of fence sitters, who can move into debt or into equity, will look at the past return and then take a call. On a one-year basis, neither the duration fund nor the equity have delivered such a wide outperformance or divergence that the fence sitters will choose one asset class over the other. My guess is that the debt investors will continue to remain within the debt. However, their shift may shift from duration fund like gilt and bond fund into credit accrual funds where the 1-year return, 2-year return, 3-year return looks attractive. Okay. On the equity side, we will see people more moving into multi-cap funds where the returns are attractive, and mid-cap funds where returns are attractive. So the fence sitters typically look at last 1-year performance and decide their call, and there's no great divergence between debt fund and equity fund to make that call going forward.
Okay, so for the year 2016, Nilesh, what are the sectors that you would be bullish on?
So one caveat is that 2016 is more likely to be stock specific year rather than sector specific year. Within sector, there will be enough divergence like we saw in 2015. In 2015, in the largest sector of banking and financial services, we saw retail-focused consumer bank delivering great return. We saw corporate-focused private sector banks delivering negative return. And we saw public sector banks delivering significantly negative return. So within the banking and financial services space, which stock you picked up delivered far better outperformance compared to just taking a pure sector call? My feeling is that in 2016 we are going to witness the same thing. With that caveat, we believe today we are in a scenario where rural India, because of the 2 consecutive below average monsoon, is on the back foot. The private sector investment, courtesy the leverage enjoyed during the boom years of 2008 onwards, are also on the back foot. Effectively, that leaves the government spending in road, railway, defense and infrastructure sector. So all non-leverage companies which are enjoying the benefits of government spending in these sectors probably, after having run up, still provides reasonable opportunity. We are also looking forward to the consumption sectors which will benefit from the 7th Pay Commission revision, which will be announced in calendar year 2016. So urban consumption like automobiles, white